Pop quiz. What's the easiest and fastest way to become a millionaire? You got it. Index fund investing. I'm going to walk you through the basics of index fund investing, show you a couple of my favorite index funds and ETFs that you can invest in today, and show you step by step how index fund investing can make you a millionaire. I'm going to keep things pretty high level in this video, so if you have any specific questions or want me to go into more detail, just let me know in the comments below. All right, let's get into it. So what is an index fund and why should you invest in them? An index fund is an investment vehicle that tracks a certain index. So an index fund gives you the ability to make one specific investment in the index fund, and yet you'll hold a number of different individual stocks in a certain proportion within that same index fund. Now, to illustrate what I mean there, let's take a look at what the S&P 500 index is composed of. So the Standard & Poor's 500 index, or simply the S&P 500, is a market capitalization weighted index of 505 large cap US stocks. The index accounts for 80% of the market value of the US equities market. Because it reflects nearly all the largest stocks in the US, it is often regarded as synonymous with the market as a whole. It's the closest there is to a default US stock index. So basically how it works is the largest stocks by market capitalization get the largest share of the weighting. So if you buy $100 of an S&P 500 index, you're going to have 7.1% of it, or $7.10 of that $100 you bought is going to be an Apple stock. And then 6% of it is going to be Microsoft, or $6. And then 3.7%, or $3.70, will be Amazon, and $2.40 will be Tesla, and so on and so forth. So another question I have is, what is the goal of an index fund? The goal of an index fund is to match the performance of whatever index that it's tracking. The goal is not to beat the index, it is to match exactly how the index is performing. Now, this is very different from a mutual fund, where the mutual fund manager is trying to beat the performance of whatever index that it's being benchmarked against. Another really important distinction of index funds is that they are passively managed versus actively managed. So an actively managed fund has a fund manager and a team of analysts who are doing a bunch of work and analytics to determine which stocks are going to be the best, which ones they should invest in, and which ones they should sell. Whereas in a passively managed fund, all of this work is being done by a computer. So this means for a passively managed funds, expenses and fees are typically very low because they don't have to pay for a huge team of analysts to do all the work that a computer is doing. Most mutual funds can have fees between 1% and 2% annually, which can be brutal to your total returns, while index funds can have fees as low as 0.02%, 0.03%, extremely small. Another important distinction is that index funds and mutual funds are traded via a different mechanism than ETFs, or exchange traded funds. ETFs are traded the exact same way that stocks are traded, which means at any time during normal business hours, you can buy and sell ETFs. While mutual funds and index funds, you can only trade them once per day after closing. Now, this shouldn't be too big of an issue for a beginning investor. Honestly, your strategy should be buy and hold as opposed to buy and sell and trade in and out. Another important thing to note is that some index funds have minimum investment thresholds. These thresholds can be very small, on the $100, $200 range, going all the way up to $1 million and above. So why are index funds a better investment vehicle than stocks or cryptocurrency or really anything else that you can invest in? Let's turn to one of the most famous investors in the world, Warren Buffett, who will give us an answer to why index funds are so great. Buffett specifically recommends them, or index funds, as a way to boost retirement savings. Consistently buy an S&P 500 low-cost index fund, he told CNBC's On the Money. I think it's the thing that makes the most sense practically all of the time. He goes on to say, the trick is not to pick the right company, Buffett says. The trick is to essentially buy all of the big companies through the S&P 500 and to do it consistently. Another reason that index funds are great is because they can make you a millionaire. With just a modest initial investment and a small monthly contribution and a lot of time, you can easily become a millionaire through index funds. And let me show you how. So this website is investor.gov, and this is their compound interest calculator. So if we start with just a $10,000 investment, $250 monthly contribution, and 35 years. So let's say you're 20 right now, 35 years would put you at 55 years old. Or if you're 30 right now, this would put you at 65 years old. And an interest rate of 10%. And you can see that just over 35 years, investing $10,000 and $250 a month, you will have just over $1 million, actually almost $1.1 million. This calculator is really cool. So it shows you your total contributions are only $115,000, but you're almost 10xing that at the end. You have over $1 million. The great thing about an index fund is since you have a little bit of so many different companies, if one company goes bankrupt, your portfolio isn't going to be hammered. It's going to have a very small effect. Another reason index funds are a great investment is that they have a long history of providing predictable returns, many times as much as 10% per year. Another reason index funds are great is because you don't need to pay a financial advisor to help manage your money. You just stick around, watch this video to the end, and you'll have a great idea of how to begin investing on your own so you can deliver great returns over a long period of time for yourself. I think 25 years ago, people needed financial advisors because it was hard to actually buy and sell stocks. You had to physically find somebody in a phone book, you had to call them up. It was actually a really challenging process that has been so streamlined and simplified that you can do it all through an app on your phone. So you may be asking, how do I actually go about buying and selling index funds and ETFs? Well, first you have to open up an account with a brokerage. I actually like to use Charles Schwab. There are many others on the market that are great, that provide easy access to many funds and don't charge any fees when you trade. Some of the top brokerages that you've probably heard of are Fidelity, E-Trade, Robinhood, Webull. All of these companies are great and would be a great place for you to start. Okay, so now that you have a brokerage, how do you actually go about researching which index funds you want, and how do you set up your portfolio? Let me walk you through a great free resource called etfdatabase.com, and I can show you exactly how I evaluate index funds and how you can do the same. etfdb.com is actually one of my favorite free resources to help research index funds. So let's type in VOO and hit search. So this is Vanguard's S&P 500 ETF. So the most important things that I look at here is, number one, take a look at this description here so I can see what the fund strategy is. Number two is look at the expense ratio. So you can see here a 0.03% expense ratio is extremely small. And then I like to go and click on performance and see what has the performance been over the previous couple of years. So you can see here it's down 10.86%, which is less than the category average. You can see over the 5-year return, it's 82%, which is more than the 37% ETF database category average. So it's a great place to come see quickly what's the performance been, what are the fees, and what's the strategy. So now you know what an index fund is, you know how to get a brokerage, and you know how to research index funds. What's a good beginner strategy for investing in index funds? First, and probably most importantly, is you need to find 1 or 2 large index funds that can serve as your portfolio anchors. So these would be index funds that track a broad market and give you a lot of diversification. Depending on your risk tolerance level and when you might need access to this money would vary how much I would suggest you put into this. But I think for most beginners, you probably want to put about 80 to 90% in some general broad index funds. So some good examples of this would be the Schwab S&P 500 Index Fund and the Vanguard Total Stock Market Index Fund. Now, one really important caveat here is to avoid what's called portfolio overlap. So that means you wouldn't want to buy 2 different funds that have very similar portfolio holdings. So what that means is if you buy a Schwab S&P 500 fund, you wouldn't want to buy a Vanguard S&P 500 fund because the portfolios are going to almost entirely overlap. And so you're going to have no benefit of diversification because you just have 2 funds that have the same exact things in them. Now, the second piece of your portfolio, which I would suggest for any beginner, would probably be about 10 or 20% putting into an industry or sector fund. Now, these funds are great because they generally can provide a little bit more upside. They're a little bit riskier because you're tied to a specific sector or industry, right? So you could have a very technology-focused index fund. You could have a semiconductor-focused index fund. You could have an energy-focused index fund. So basically, this gives you the opportunity to think through what your investment strategy is and think which sectors do you think are going to be growing in the future, and then put, again, 10 or 20% in there. Now, this could be a little bit more of a risky strategy because, again, you're putting more of your eggs in one basket, right? If you pick technology stocks and technology starts to nosedive, then you're going to have a lot more of a negative impact on that fund. Now, I think probably the best beginner strategy for somebody who really doesn't know what they're doing and doesn't have the time to figure it out and want to research it too much, I would suggest to that person to invest in a target retirement fund. Now, target retirement funds are great for investors who want to keep things extremely simple. You can pick a fund that has a retirement date that sounds good to you, and the fund will automatically adjust your portfolio over the years from a more risky or equity heavy portfolio to something a little bit less risky and probably bond heavy. This is essentially moving from a higher return potential but more risk to a lower return potential but much less risk and volatility. Okay, now I think you're actually armed with a lot of the basics for how to go about investing in index funds. You know what an index fund is, you know how to open a brokerage account, you know how to start researching index funds, and you have a pretty good basic strategy for how to go about doing it. So now let's talk about timing. When should you invest? So as you all probably know, 2022 has been a crazy year for the stock market. But I think now is actually a great time to invest if you don't need the money in the next 3 to 5 years. A really important strategy with investing is what's called buy and hold. You want to buy and hold these index funds and keep them for as long as you possibly can. One of the worst things you can do is buy an index fund, have it for 3 or 4 months, see it start going down a little bit, and then sell it, trying to time the market, waiting until it starts climbing back up again, and then buy back in, hoping to maximize your return. This is actually a recipe for disaster, and very, very, very few investors are able to succeed at this. The best long-term strategy is just to buy it and let it run for as long as you possibly can until retirement. Let compound interest work for you. One final concept that I want to walk you guys through is what's called dollar cost averaging. Now, what this strategy is basically take a fixed amount of money each month and just continually invest it. No matter what the market is doing, if it's up, if it's down, if it's sideways, it doesn't matter. Take that $100 or $1,000 or whatever it may be and invest that money each and every month. And this is a great way to maximize your returns over the long run. All right, guys, this wraps up the video. I really hope you feel a lot more prepared now to navigate investing in index funds. If you found this interesting or helpful, please don't forget to smash the like button and subscribe to my channel so you won't miss any of my future videos. Thank you guys, and I'll see you next time.